All right, let's bring in Steve Sosnick. He's the chief strategist at Interactive Brokers. We also want to bring in Noelle Corum, senior portfolio manager at Agile. It's great to have both of you. Steve, just your quick reaction to this report and whether or not maybe this does change the calculus at all.
Well, Seana, I'm not sure it does in a major way because, yes, the headline number was lower. My first reaction was, that's not good. That doesn't jive with what we heard from ADP, which is a very imperfect indicator anyway. Mm-hmm. But then when you, as you mentioned, with the revisions being much higher than we thought, and then we have the unemployment rate going down. And to me, the interesting one is the monthly gain in average hourly earnings at 0.5 as opposed to 0.3. That's telling us that people have jobs. Most of the people who want jobs have them, and those who have jobs are getting paid more. Mm-hmm. And if you're talking about, again, the dual mandate of the Fed, which is stable prices and full employment, well, you've got your full employment, at 4% unemployment rate, and do you have your stable prices? Again, I want people to get paid. I mean, that we all should do that, and we all should root for a stronger economy as opposed to a more accommodative Fed. But that's what this number tells me. The Fed is not this doesn't incentivize the Fed to do anything right now.
Noelle, I want to get your initial read in on the print.
Sure, I had the similar reaction as Steve, like, whoa. But if you actually look at the revision, we are looking for a trend around 200. That's right in line with what we would expect. The Fed's looking at the trend. We really don't think it changes the calculus, as you said, for the Fed and where they want to go this year.
Steve, how do you think, just taking a look at the market's reaction, if we could put the 3 board up just in terms of the major averages and some of the action that we're seeing here in pre-market, I think it very much aligns with the fact that we haven't seen too much movement here.'re right around where we were right before this was released and right after it was released here. What does that signal to you just in terms of what the market is looking for? And it looks like this report, given the revisions, is enough to keep that narrative intact.
Well, I think so, because there's this dichotomy of do we want, yes, in the perfect world, some of what we got last year was an accommodative Fed and a strong economy. I think they're moving away from that notion of giving us both. So again, I think if we have to choose, we should choose the stronger economy, which is why we see a fairly muted reaction in stocks. It's a little disappointing, from that point of view. But I'm watching bond yields right now, and I'm looking at my screen. They're about 3 or 4 basis points higher. So taking the lead from the bonds, if the bonds aren't freaked out, well, then why should stocks be? Because this is probably a more bond unfriendly number than it is a stock unfriendly number.
Yeah, Noelle, as we've been talking about this morning, the reaction for the markets relatively muted off of the back of this report, even if to the downside, just fractionally here, flat, barely to the downside. What is the initial trade that comes to mind for you off of a print like this, knowing how the Fed might ingest it?
For us, what we're focusing on this year is the 3 T's, so tariff, tax cuts, and term premium. How is policy going to play into those, and how's it going to feed down into the data, right? So far, especially in the first half of this year, we think growth's going to be solid. The Fed's going to be on hold for a majority of the first half, potentially looking to renormalize later in the second quarter. And of course, inflation is going to be muted. So what does that mean for markets? It means that risk is actually going to do well here. And so we do like risky assets here. And then you can kind of pull in duration when you need to, if you see some of those tariffs, tax cuts, and term premium play out into the market.
Steve, should we at all be concerned about the average hourly earnings that you brought up there? The fact that was much stronger than what forecasts had been predicting, and the inflationary pressure maybe that this could cause down the road.
This could cause inflationary pressures down the road because, again, higher wages do tend to lead to higher inflation. But again, that's probably a good kind of inflation because right. The price of eggs and coffee going up is not a good cause of inflation. The fact that more people have more money to spend and feel better about it, especially if they can actually save some, but people don't always do that. But that's sort of a healthy way if you're going to start having a little bit of inflation.
To what degree then, or I guess what is the threshold for it not to be healthy?
When it's really exogenous. Again, so there's so many soft commodities that are seeing rallies for just strange reasons. Or as Noelle referred to, tariffs are inflationary too. At least you can argue whether it's a long-term or a short-term blip. But either way, they're not helpful for prices or consumption. You're spending more money on essentially taxes, and so those are more harmful as opposed to just the economy's doing well, people are productive, they can afford to get paid more. that's a good thing.
Noelle, is there a basket of companies or a trade that is more exposed to higher labor costs as passed through to the mindset of the consumer and could rattle consumer spending so much so to the point where it also impacts those companies' outlooks?
So if we take a big step back and kind of think about where we are in this cycle, what names do we like here? We like names that are going to be cheaper relative to their peers, right? Because those are going to be the names that do well when growth is doing well, when inflation is somewhat contained. You were just talking about wages. We think that the trend there is still going to be a little bit higher than where we need to be, around 2 to 3%, but it's still not enough to really feed into inflation, at least in the near term, in a significant way. As we get into the later part of the year, though, of course, we have to start thinking about policy, have to start thinking about tariffs, tax cuts, how that feeds into inflation. But for now, we really like to be in kind of that sweet spot of value where you do see some spread pickup in particular names relative to their peers.
Steve, what's your top trade as you look at this?
Noelle mentioned value, and I think that remains my top trade. I think we're seeing a lot of portfolio managers rotate into value. We're still seeing a lot of individuals and more active traders still trading momentum, and it's hard to break their sort of love of big tech. But I think we're seeing a lot of money move into more defensive sectors, things with a bit of dividend, things that might withstand some of the volatility, because I do think we're going to get into a more volatile environment. And as an options guy, that means there's plenty of opportunities. But from an investment point of view, I think it behooves most investors to think a little less volatile.
And so if leaning into value right now, what is the time horizon? Or I guess the better question is, what would actually move the thinking for investors off of the value trade later down the line?
They've been off that trade for like 5 years, Brad. So really, it's what would move people back. People love the growth stocks, and let's be clear, that's what's brought everybody to the dance. And it's hard to, you're not going to abandon them, but I'm just saying maybe look at some of the wallflowers now and then.
Yeah, we were taking a look at some of that data showing the amount of new market entrants since 2020, which, to your point, so many new market entrants because of that growth trade that has really been prioritized.
Noelle, real quick, before we let you go, let's just take a look one more time at the bond market here and the reaction that we are seeing. You've got yields pushing back towards that 4 or 5 level. Where do we go from here?
So I think the bias, given where policy is going from here, given the things that we need to watch, the bias is for higher yields. So we do think it makes sense to pull in duration for now. We still like risk here, though. Let's make that clear. And we continue to like names that are cheaper relative to their peers.
Steve Sosnick, Noelle Corum, thanks so much for taking the time today.